Welcome to the video. You have a strong debt-free base and over $60,000 in reserves, which is a fantastic start. However, the main threat now is not debt, it is inflation. In this video, we will reframe the risk of investing versus the guaranteed loss of purchasing power from sitting in cash, and we will give you a clear plan to move from saver to investor. Now, let us set the stage with the core message before we dive into the agenda. You have successfully built a substantial cash cushion and eliminated debt. That puts you ahead of most people. Now, however, the priority shifts. Inflation continuously reduces the purchasing power of idle cash, and that loss is certain over time. Investing appears risky, but not investing guarantees erosion. This video will help you transition from saving to strategic investing, starting with safety, then maximizing tax-free accounts, and then embracing calculated risk for long-term growth. Next, let us outline the roadmap for today's session. Here is our agenda. First, we will explain the hidden cost of cash. Second, we will right-size your emergency fund. Third, we will maximize tax-free accounts, such as a TFSA or Roth. Fourth, we will discuss diversified growth to target 8 to 10% long-term averages. Fifth, we will give you a 30-day action plan. We will also include quick quizzes to check your understanding and end with key takeaways. Now let us begin with the hidden cost of cash. Inflation is a continuous force reducing the purchasing power of money. If your savings account pays 0.5% and inflation is 4%, your real return is approximately negative 3.5%. While cash appears safe because its nominal value does not fluctuate, its purchasing power declines. That is not true safety. Additionally, the opportunity cost of not investing compounds over years, creating a large wealth gap. The decision rule is to keep sufficient liquidity for emergencies and short-term needs, then invest the remainder according to a plan. Next, we will compare cash and investing side by side to make the trade-offs concrete. Cash provides immediate liquidity and nominal stability, which are important benefits. However, the predictable erosion from inflation and the lack of compounding are significant drawbacks. Investing, on the other hand, introduces volatility in the short term, but offers compounding and a high probability of outpacing inflation across long horizons. Diversification and discipline help manage the volatility. With that framing in mind, let us allocate your $60,000 intelligently. This pie chart shows one sample way to allocate $60,000. $20,000 remains in a readily accessible emergency fund. $30,000 prioritizes tax-free contributions such as a TFSA or Roth to maximize compounding. $5,000 is reserved for short-term goals within 1 to 3 years. The remaining $5,000 can be used to begin a diversified brokerage position. Your exact allocation should reflect your risk tolerance, time horizon, tax rules, and contribution room. Now, with the high-level allocation in place, we will move into a concrete 30-day action plan. Here is a simple 30-day plan. In week 1, confirm 3 to 6 months of expenses and set a $20,000 emergency fund in a high-yield savings account or a short-term treasury bill ladder. In weeks 1 to 2, open or review your TFSA or Roth, calculate remaining contribution room, and set automated contributions. In week 2, select a diversified core portfolio using broad index exchange-traded funds or a balanced multi-asset mix. In week 3, either deploy a lump sum or use a systematic dollar-cost averaging schedule over 4 to 12 weeks while setting a target allocation. In weeks 3 to 4, establish guardrails, including written investment policy, rebalancing bands, and automated investments. Ongoing, review quarterly, rebalance within defined bands, and increase your savings rate as income grows. Next, we will compare account types and their tax treatments to help prioritize contributions. This table summarizes 3 common account categories. A TFSA or Roth uses after-tax contributions. Growth and qualified withdrawals are tax-free, making them excellent for long-term compounding and flexibility. An RRSP or 401k typically offers pre-tax or tax-deductible contributions. Growth is tax-deferred, and withdrawals in retirement are taxed as ordinary income. A taxable brokerage account uses after-tax funds, with taxes on dividends and interest, and capital gains taxes when you realize gains. A typical order of operations is to maximize TFSA or Roth first, then contribute to tax-deferred accounts at least to capture any employer match, and then use taxable brokerage for additional flexibility. Now, let us discuss return targets and risk management. To outpace inflation and build meaningful wealth, a reasonable long-term target is an average annual return between 8 and 10%, recognizing that individual years will vary widely. The core engine is global equity exposure complemented by stabilizers, such as high-quality bonds and possibly real assets. Implementation via low-cost, broad index exchange-traded funds or balanced funds keeps costs and complexity low. Risk management includes defined rebalancing bands, a written investment policy, and maintaining an emergency fund so you are not forced to sell during downturns. Behavioral discipline is critical. Automate contributions, focus on a 10-year or longer horizon, and avoid market timing. Next, we will visualize an investing timeline to guide your first months. This timeline illustrates the sequence for getting invested and staying on track. In Week 1, set the emergency fund and open accounts. In Week 2, choose a diversified set of exchange-traded funds and a target allocation. In Weeks 3 through 6, deploy capital using a lump sum or dollar-cost averaging schedule, and establish automatic investments. Each quarter, review and rebalance within your predefined bands. Annually, verify contributions, optimize for taxes, and review your investment policy statement. Now, let us test your understanding with a quick quiz. Question: which of the following represents a guaranteed loss over time? Options: A. Inflation eroding idle cash. B. A diversified index fund held for 10 or more years. C. A high-interest savings account always beating inflation. D. Holding cash inside a TFSA or Roth avoids inflation. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. Inflation eroding idle cash. Inflation reduces purchasing power consistently over time, regardless of the account type. A diversified index fund held for long horizons has historically offered a high probability of positive real returns, though not guaranteed. High-interest savings accounts do not always beat inflation, and placing cash in a TFSA or Roth does not insulate it from inflation. It only affects taxation. Next, let us try a second quick quiz on emergency funds. Question: where should a $20,000 emergency fund typically be kept? Options: A. Individual stocks for higher yield. B. High-yield savings, a money market fund, or a short treasury bill ladder. C. Cryptocurrencies for potential upside. D. A long-duration bond fund for higher returns. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Emergency funds need safety and immediate access, so high-yield savings accounts, conservative money market funds, or short-term treasury bill ladders are suitable. Individual stocks, cryptocurrencies, and long-duration bond funds introduce volatility and interest rate risk, which are inappropriate for emergency reserves. Next, a quick sequence view of how to prioritize account funding. This sequence diagram shows a typical priority. First, the investor maximizes TFSA or Roth contribution room to capture tax-free growth. Next, the investor contributes to an RRSP or 401k at least to capture any employer match and potentially more for strategic tax planning. Finally, the investor allocates remaining funds to a taxable account for additional flexibility. The notes emphasize the tax characteristics of each account type. Next, before we close, let us include an important disclaimer. This content is educational and is not financial, legal, or tax advice. Investment returns are not guaranteed and can be negative in any given year. Tax rules, contribution limits, and account features differ by country and may change. Consult a licensed professional who understands your specific situation before acting. With that said, let us wrap up with the key takeaways. These are the key takeaways. First, inflation erodes idle cash, so certainty of loss is not true safety. Second, size your emergency fund appropriately and invest the remainder. Third, maximize TFSA or Roth accounts to harness tax-free compounding. Fourth, use diversified, medium-risk assets to target 8 to 10% over the long run. Fifth, automate contributions, rebalance within rules, and maintain a long time horizon. Finally, let us summarize your next move and how you can support the channel. To conclude, secure your $20,000 emergency fund in a liquid, safe place. Maximize your TFSA or Roth so cash is not idling in a high-potential account. Replace fear with a framework by defining a diversified allocation and written rules. Start now, because inertia is the biggest mistake. If this video helped, please like it, share it with someone who is sitting on too much cash, and subscribe for more practical finance content. Tell us in the comments how you plan to deploy your cash over the next 30 days. Next, a final thank you before we wrap. Thank you for watching. We appreciate your time and attention. Please like, share, and subscribe, and let us know in the comments what step you will take this week to move from hoarding cash to investing with purpose.